But as the global central bank sovereign institutional de-dollarization, US Treasury to gold conversion process escalates, it's only a matter of time before the long bond yield rises above 5%, which is deemed as the inflection point that would likely trigger yield curve control, flooding the market with cheap money, which will be hedged with global central bank gold buying. With the US lagging global central bank gold buying, and with only 8,100 odd tons of empirically rehypothecated US Treasury holdings, everything points to a cash-settled, forced gold revaluation. With the LBMA, CME now becoming price takers, buying back leased gold reserves will have to be conducted at market. Conservatively, this reaffirms our minimum target of 4,500 by the end of the year.
AndrewMaguire has been clear that the recent gold market dynamics expose how Wall Street's public narratives are often at odds with their private actions. Not long ago, banks were pushing headlines that gold could collapse to levels as low as $2,600, even as their own trading desks quietly positioned for higher prices. While investors were being warned of downside risk, the same institutions were stealthily closing out derivative bets and preparing for a move in the opposite direction. This, he argues, is a sign that the long-standing paper gold suppression strategy is reaching its limits, as physical market demand forces a shift that the derivatives market can no longer contain. The structural weaknesses in the COMEX and LBMA systems are now being laid bare. The so-called chips on the table, the open interest that historically allowed for heavy paper gold price management, have thinned to the point where the Fed, the last central bank still leaning on short positions, cannot maintain control. Arbitrage opportunities between suppressed Western paper prices and higher Asian physical premiums have made it increasingly difficult to keep the illusion intact. Maguire points out that the inefficiencies of refining large London bars into the kilobars demanded by Asia, combined with the relentless drain of unallocated contracts into allocated physical holdings, are eroding confidence in the Western system. As liquidity providers exit, the COMEX and LBMA structure is being forced to confront the reality that physical markets, not paper, are setting the true global price of gold. This unraveling leaves policymakers with little room to maneuver. The Bank for International Settlements has already been forced into compliance, covering its short positions at higher prices, and pressure is mounting on the Fed to follow suit. Delivery demands are exposing the fact that many of these paper contracts were never backed by actual bullion. Now, with record physical offtake and the largest deliveries in history, the clock is running out. Maguire suggests that the Fed will eventually have no choice but to fold its short derivative hand and accept a revaluation of gold, one that could see prices gravitate toward targets closer to $4,500 as physical markets fully reclaim control. Before we dive into Andrew's sharp insights from his latest interview with Mario Ineco, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
And yeah, this is the same bank that, along with JP Morgan, that we captured and published at that exact same time, simultaneously stealthily closing the Fed's 5-year OCC derivative bets. Remember those OCC bets, the officer controller bets? They're only published quarterly. So these guys get to have a bit of fun and do what they want to do in the dark until it's published. But we clocked it. And this really actually all boils down to the fact that the only central bank still short gold is readying to revalue US Treasury gold reserves. I know there's a lot of skepticism about it. It's happening. And as we've been drawing attention to, and we will look at it again shortly, the clues are all there. And our assessment that the LBMA COMEX is no longer fit for purpose is now gathering mainstream attention. And with that in mind, let's look at the current August CME LBMA footprints, which after the Trump tariff tantrum further reveal how a dwindling COMEX open interest, i.e. the chips, no one wants to really trade the chips anymore. It's forcing discipline on the Fed, the only remaining central bank trying to cap the price of gold and versus the dollar. And they need the COMEX to do that. And it is just, there's not enough actors. And even setting aside the Western paper-derived price mismatches versus the Asian-facing physical pricing, it was the Trump tariff tantrum that really exposed the massive structural mismatch between the Western gold market infrastructure and particularly the inefficiency of re-refining London 400-ounce bars into 1 kilo bars that Asia demands.
Liquidity providers affirm that the remaining COMEX open interest, that's the chips in the casino basically, are insufficient to command enough position concentration to actually meaningfully enable the COMEX-centric paper gold price management to continue. Now, the Fed's price suppression attempts have become so obvious that anticipated intraday, intra-month, COMEX-centric official bid-pulling attempts are capitalized on by the competing global central bank, sovereign, and institutional buyers. Now, these arbitrable physical offtakes are making it increasingly difficult for the Fed to short cover leased bullion borrowings without digging a deeper hole. Into the end of the month, the Bank of International Settlements squaring the OCC bets were once again forced to be squared at an all-time higher priced stairstep. And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation process. Feedback from every single physical liquidity provider's telegraph that the Fed is anticipated to follow the BIS to also become Basel III NSFR compliant. And remember where the BIS short covered and what happened. And now the Fed is at the position where it's got to short cover. And it's going to have to follow what the BIS did. And then figuring that most likely that the December contract, this is spot here, but this contract, which just launched, which was the December contract, and this reflects that COMEX liquidity, is very likely going to have to move in. It'll move into first notice on the 27th of November, and delivery commences on the 28th of November. So this contract doesn't expire until November. Well, we suspect that the price is going to be much more reflective of our spot 4,500 target. Cutting through the last 3 weeks of the thinnest European, this was the European holiday here, that liquidity was extremely thin. This tariff tantrum right here was the point that actually exposed the need to quickly address the LBMA CME cartel's paper to physical disconnect. And liquidity providers report the largest exit of LBMA CME hedging flows, ditching these high counterparty risk unallocated contracts for fully allocated physical gold. And that's what we're seeing.
Now, the drain of leveraged unallocated LBMA gold into fully paid up physical gold vaults outside the cartel's ring fence will ultimately force the Fed-run cartel to embrace full Basel III compliance or become irrelevant as a gold trading hub. And what we mean by Basel III compliance, they will have to have the physical that backs up these positions. Drilling down, the footprints are revealed one by one. And as we assessed in our last episode, following the largest technically non-delivery month, just a futures month that really wasn't designed to be a delivery month, the August gold loadout, it was the largest in history. And we expected that any remaining undelivered paper warrants would be forced into delivery by first notice on the 28th of August, which was the last day to contractually deliver or fold your position. And as we've often remarked, in physically settled markets, gold being called for delivery is settled at worst T+1 and in many of the futures markets, physical markets, T+0, but T+1, meaning 1 day to physically deliver a fully paid up bullion bar. So that should be the worst case scenario because that is Basel III compliance.
One of the strongest bullish forces now shaping the gold market is the quiet but deliberate shift by large institutional investors and sovereign pension funds. Reports suggest that Chinese pension funds, with trillions in assets under management, are being directed to increase their gold allocation from just 1% to much higher levels over the coming years. Even at the initial stage of this mandate, when gold traded near $2,700, the buying translated into hundreds of tons of new demand, equivalent to a significant share of annual global supply. Since then, gold has climbed nearly $900 per ounce, underscoring how quickly the impact of these structural reallocations is being felt. If such allocations continue to scale, particularly across BRICS nations, the gold market could face demand that far exceeds available supply. The shift is not limited to China alone. India is weighing similar reforms that would allow its vast $177 billion pension system to allocate into gold ETFs, potentially drawing in tens of additional tons of demand annually. Meanwhile, central banks across Asia and the Middle East have been accelerating their purchases in response to the freezing of Russian assets in 2022 and the reclassification of gold as a top-tier reserve asset by the BIS. These moves reflect a broader de-dollarization trend, where sovereign borrowers are opting out of U.S. treasuries in favor of gold and other alternatives, thereby redirecting the foundations of global finance. Liquidity providers estimate that when unreported flows through complex trade routes are factored in, real central bank accumulation could be tens of thousands of tons higher than official figures suggest, an amount not yet fully reflected in market prices.
Now, they definitely that feedback is very reliable. And at the inception of the mandate, gold was trading at about $2,700, equating to about 8 million ounces at the time. That was about 250 tons of a 3,000-ton supply. Since this directive, gold's risen by close to $900 an ounce at 3,500. Now, while this timeline has yet to be revealed. Now, given the current escalating BRICS trade war leading into military escalations, an additional 1,000 tons, or 1/3 of all global supply, could be demanded by the end of 2026. This feedback has been rock solid reliable, and we expect this to be announced at some point. Also, India's market regulator is considering allowing the country's 177 billion pension system to also buy gold ETFs, a move that could drain an additional 17 tons of new demand, just simply a 1% allocation. Now, this follows the Bank of India switching gears, converting US treasuries into gold directly after the BIS had recategorized FX gold as a first-year high-quality liquid asset on the 1st of January 2023, and is representative of what is also empirically evident across the entire BRICS sphere. Also, sovereign borrowers swapping out of dollar debt into lower Chinese and Swiss interest rates. Asian and Middle Eastern investors are avoiding exposure to the US. Also, it's filtered through to the Financial Times through Goldman's desk, picking up on some unreported central bank gold purchases. Our liquidity providers have been reporting this since Russia's assets were frozen in February 2022. I think a lot of people knew that this was happening, but I think what's interesting is that obviously we knew that physical gold buying had significantly accelerated when the Bank of Internationals squared all their remaining 500 tons of gold swaps. If you remember, that was on the 1st of November 2022. And that was just before the BIS revalued gold as a first-year high-quality liquid asset on the 1st of January 2023. So for reference, net of paper market dilution, when including direct doré bar imports that seemingly disappear into the 42 district Chinese customs districts, which feed into a 678 loco customs matrix. And we've talked about this before. So much is lost through this system. And we figure this is likely military gold that doesn't get reported. Then if we just base that purely on real global supply demand fundamentals, these same liquidity providers now estimate real, unreported central bank monetary gold demand, not captured even in Goldman's assessment, is closer to 42,000 tons. This is not yet priced in, but it still marries with our end of year $4,500 target. Now, these swaps of US treasuries for gold cannot be, they're just, obviously the White House knows what's going on and they are following it. And so obviously after the bullish for gold. India, China, Russian SCO's summit, which is only just finished over the weekend, this will have severely ruffled the White House's feathers, driving another round of fresh safe haven gold and critical mineral silver demand at the expense of the dollar. In fact, directly pushing back against those pushback, the White House pushbacks. Now, we're going to update more on these extremely bullish developments as they progress. But as the global central bank sovereign institutional de-dollarization, US Treasury to gold conversion process escalates, it's only a matter of time before the long bond yield rises above 5%, which is deemed as the inflection point that would likely trigger yield curve control, flooding the market with cheap money, which will be hedged with global central bank gold buying.
With the US lagging global central bank gold buying, and with only 8,100 odd tons of empirically rehypothecated US Treasury holdings, everything points to a cash-settled, forced gold revaluation. With the LBMA, CME now becoming price takers, buying back leased gold reserves will have to be conducted at market. Conservatively, this reaffirms minimum target of 4,500 by the end of the year.
Looking ahead, the implications of this demand wave are profound. If global pension systems and sovereign wealth funds formally embrace gold as a strategic reserve asset, the resulting surge in buying could drive prices well beyond current targets. With supply-constrained and paper-based pricing mechanisms losing credibility, the market may be forced into a revaluation where physical demand sets the benchmark. Silver, often overlooked but tightly linked to gold's monetary role, could experience an even sharper repricing due to its thinner market and dual industrial monetary function. Should these dynamics unfold as projected, the world could be on the verge of a historic shift in which both gold and silver reassert themselves as core pillars of the financial system, fundamentally challenging the dominance of fiat currencies. That's it for today. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.